We'll just give it a minute. Hi, this is Corey Parnell. I'm with BGM Group, and we're just going to give it another minute as people are still logging in. So just one moment, and then we'll get this kicked off. All right. Well, we'll get started then. Thanks everyone for taking time and joining us for this webinar. And today's subject is it's really chaos to clarity driven by a fractional CFO. I'm excited to have our two panelist members that'll be talking through some of these questions that we have around this. Really is Brian Stubbe, who Brian is our leads our outsourced accounting service group at BGM. He has 20 plus years of experience in his current role. Brian leads a team of professionals that assist companies with business advisory, fractional CFO services, and accounting services as well. He's experienced in providing others with the necessary guidance, whether the issue or opportunity is related to business, financial, systems, people, or process. In addition to his advisory expertise, Brian brings a wealth of experience in onboarding project management to optimize accounting functions by utilizing the combination of technology, people, and process improvement. And then our other person is Patrick Wheeler. Patrick is an outsourcing CFO at BGM. Who provides fractional CFO services, including reorganization, financial planning, analysis, and ongoing leadership within the department. Again, Patrick has 20 plus years of experience with large international organizations that really he's able to bring some of those concepts to clients that we work with. He excels at advising business owners on strengthening their personal and business financial positions. He's accomplished in providing clients with the necessary guidance, whether the challenge or opportunity is related to business, finance, systems, people, or processes. So again, I'm excited about covering this subject matter. And so the first question that I have for Brian is, just a moment. Technical difficulty, sorry about that. Is Brian, how do you assess the current state of an accounting department in business?
Thanks, Corey, for the introduction, and thanks for the question, and it's a great question. First, to assess anything, you need some type of benchmark, and I would submit that, including me, we've done a really horrible job educating owners and management of companies of what they should expect from their accounting department. But over the years, including this group, we've collaborated and synthesized what an owner and a management team should expect from their accounting department, and it comes down to three things. One is they have to be able to efficiently transaction capture and code. Two, they have to translate those recordings to accrual basis. And three, and most importantly, have someone interpret the numbers, the ability to tell the story trend analysis for the owners for them to perform better. So I'll go back to bucket number 1 with regard to transaction capture and coding. Oftentimes that requires implementation or optimization of systems as well as people. And number 2, with regard to cash to accrual, we're really talking about organizing the financials into more of a management reporting function versus compliance related. So just really organizing that data. In terms of some examples of some adjustments that need to be made, oftentimes a company will get a deposit in front from a customer ahead of time. They'll record that as revenue. And certainly from a cash basis, that's correct. But from an accrual basis, that business did not earn that revenue, so an adjustment needs to be made. So that's really what is involved in bucket number 2, to get some consistency within the financials so that we can perform that analysis and trends. And bucket number 3, we'll spend a lot of time on today with regard to CFO function and dive deeper into that bucket as well. But that's really in a nutshell what an accounting department should be measured against.
So can you talk a little more about, the process and the conversation that you or we have with clients when you go through the assessment process, and how long does that normally take?
Yeah, so we have a really simple process that we go through. We have a 2-page questionnaire that we send out, and we have the business fill that out. And then after we get that back, we go through a information gathering meeting. So we'll dive deep into those 3 buckets with regard to their current state. So then we can measure exactly what needs to happen to get them optimally set up to what I just talked about from a benchmark perspective. So oftentimes we'll see missing processes, so transactions that aren't recorded. We'll see there's no talent there from a CFO advisory. They're not meeting with management, so accounting departments should be meeting at least one hour a month, talking about their financial position of what the previous quarter was and what's forward looking. And lastly, the systems are generally not integrated. They're not set up properly. Their master file chart of accounts aren't designed properly. They never gone through that process. So, but we go through all that, and then we deliver a report in terms of our recommendations based on their current situation that we have documented in a formal report. And then we deliver that to them in a meeting. So that's kind of our process.
And I think a couple things that I've heard from companies that have gone through the process is 2 things. One is implementing new technology, and then the other is clarity on roles and responsibility. So can you and Patrick, can you guys talk about those 2 components?
Yeah, so just to start off with, when you think about what you need from a people standpoint, from those 3 buckets, in terms of the benchmark, that first bucket, transaction capture and coding, you don't really need any accounting knowledge to perform that function. So typically a bookkeeper or an office manager type role is suited for that. And then the middle bucket that we had talked about, you generally need a senior accountant or a controller type role for that one. And then lastly, that third bucket, CFO knowledge and experience is required typically to do a really good job there.
Oh, but I can step in too on the system side of the integration of the systems, right? I think it's really important to, that change management of, when you bring a system on, to fully embrace the change from the accounting department, because as I think one of our coined terms is, garbage in, garbage out. So, it starts at the pre-accounting and it flows into the systems. But if the systems can be set up perfectly, but ultimately, that's why I think those 3 levels are so important, so that once you do get to the CFO level and or to analyze results and business and where you are and where you're going to go, and that's a question later on. But you have to have those buckets, the front buckets in order prior to any KPIs or anything.
And in terms of
Yeah.
process, one of the best questions I like to ask is really to kick off a process improvement project, is really ask a group of people that are involved, when does that process start and when does it end? And inevitably, when you ask that question, there's different answers that people either aren't aware or they don't really believe that, oh, yeah, I didn't realize there was activity up front. And so it's very important to get the full process from the life cycle of it so that you can define each one so that everybody knows what the actual outcome is supposed to be. So we see that all the time with regard to inefficient processes just because they don't really realize there's actually a process prior to that. And we've labeled that really a pre-accounting type situation, really before the accounting department should see any of that data. It happens in operations or some other department. So those are a few things that we notice all the time when we do these assessments.
And I think part of the assessment process too is understanding, the financial close, right? So, there's a lot of businesses that they're not closing their books for 2 months after results are closed. And so really the understanding the cadence of closing the books, whether it's month or morning meetings while you're closing the books, but getting on a better path of closing your books within 10 to 15 business days, and so that you can actually make decisions on the back end for on that data.
Yeah, and one last thing on the
ahead.
system piece too is what we've really noticed is there's a lack of what we call an architect. No software company is going to come to a business and say, for instance, Microsoft's not going to come to your company and say, hey, did you know how to optimize Excel and use VLOOKUP tables and stuff like that? Software companies don't do that. So what they do is they deliver the software, and then what we like to do is optimize the software. And inevitably, there's no design, and that's why we've coined the term architect, to make sure that the system master files that within that system is set up properly, the transaction flow is set up properly. But it's kind of a missing piece, which is really bizarre, that software companies generally don't do that. So there's an integration or an architect that's needed.
Yeah, and part of this is driven by, the things, this process, even our organization has gone through. And probably the example I always like to use is our CFO used to download the credit card transactions for the month, do a preliminary coding of most of them, then distribute that report back to the 5 card users, get the report back, and then post, and versus just using a tool that streamlines that process and really puts the ownership of that on the front end when the transaction's happening. And that is really expedited the close process, as well as the individuals in operations. They love it because then they're not dealing with transactions that happened 15, 30 days earlier, or the earlier month, that they're able to deal with it as it's happening. And that's just an example of expediting the close, having a better process, defined process involving operations, and having them really bought into a streamlined process.
Yeah, and that's a great example, Corey, of, if you're recording transactions from a credit card statement or a bank statement, that process started way before it hit the bank statement. And utilizing a tool like Expensify, utilizing a tool and then train the users when they swipe a card, that's really when the transaction starts. And to be able to capture that through a tool called Expensify is a game changer in our estimation.
And then I'll add one more thing on that too, on that, that type of system, or like the Expensify type of tool, is so helpful too in regards to managing your OpEx and all of your expenses, right? Because there's workflow involved. Anytime anybody spends anything, you can set limits on it. So if, employee A goes and, spends $1,200 or, $1,500, that that person's manager gets alerted of those expenses. And so really you can put, and especially in regards to companies that lag in closing their books, all of a sudden right now you could be looking at February credit card statements and you don't even know what they entail versus it's real time. So I think in regards to managing that OpEx, everybody looks at the growth of the top line. Well, managing that OpEx is ultra important. And so I think that Expensify tool does that, or
I think
that type of tool.
that's a great point, right? Why do you do all this stuff? Why do you do bucket number 1 and bucket number 2? Is so that you can manage your expenses better, more visibility. And again, it goes back to why do you do all of this? Is to perform better as a business, right? That's literally what it is. So I think that's great.
And I love the fact, even though we use that tool with the credit card, I still get my points. So, which is can become a significant number for a lot of our clients on utilizing the credit card statement. And then again, how do you manage that? No different than allowing employees having access to your bank account, but then the next item I'd like to kind of talk about is, who are kind of the key players in the accounting department? We have a bookkeeper, office manager, a controller, and CFO. Maybe for everyone, can we just kind of define, what the differences are, what those roles play within the accounting department? Brian?
Yeah, I think I previously spoke with regard to, bucket number 1, 2, and 3, going back to that theme. Transaction capture and coding, again, you don't need accounting knowledge necessarily for that, true accounting knowledge, 4-year degree. So office manager, bookkeeper type, with the right software can handle that. As far as a senior accountant, generally that's a person that's able to adjust the books with regard to cash versus accrual. That's their main duty, to get the adjustments within the financials to what's incurred and what's been earned, as well as a controller. That middle bucket is generally owned by a senior accountant and controller. And then the third bucket with regard to being able to tell the story of the financials, that's truly a CFO, strong controller level type of ownership role. Now, I would submit, and this is where, true to my heart, is small businesses, it's impossible to hire one person to do all those, because there's just different expertise and interest level in doing each one of those. And that's where we fit in. Typically, we require somebody on site doing day-to-day and office manager to do bucket number 1. We take ownership. So I want to be clear here. We take ownership of being able to do it. We're just, from an outsourcing model, it just makes sense to utilize resources at the client for that, and seeing that it doesn't require accounting knowledge and we are able to train them and oversee it, it works really well. And then bucket number 2 and 3, we typically have a senior accountant, controller, and CFO on all of our engagements. So we're able to provide and hit those benchmarks of what a business should expect from their finance department in one complete package. And that's where we see an outsourcing really fitting in the small business. Larger businesses, as you get up, right, they have the scale, they can do the hiring for each one of those roles. And that's really, we're level setting for small businesses, that they shouldn't give up and say, well, we can't really get that. It's like, yeah, you can, if you outsource it and have the right partners in place, you can actually do that. We're kind of level setting that.
Yeah. So let's say we get in there, we get in regards of the financials, I'm sorry, the transactional side squared away. Then, during our process, Patrick, can you just talk about a couple things? One is, looking at the chart of accounts, how it's organized. And then there's really kind of two reports. I call it the historical report, but then also a term that I've heard recently that I really like is a management accounting report, which can be two different things, and maybe if you could talk about that.
Yeah, so to start off at the beginning, right? I think that's part of not just the assessment, but just really looking at the chart of accounts and what makes sense and what's digestible. I've been in with rather super large companies and small companies, and I think everybody over the years puts band-aids on everything because it takes so much time to kind of reinvent themselves. So, all of a sudden your chart of accounts is so large and you might have a 25-page P&L. Well, that's highly undigestible to most human beings on the planet. So you're really looking at that chart of accounts, bucketing stuff together. So if it's account or if it's advertising, it's in advertising. If it's office expense, so forth and so on. So you get a one-page P&L. And so then really looking at that and then taking not only that P&L piece of it, and then on the historical side and making sure you're apples to apples. And then from that point, building out your KPIs, understanding the roadmap of where you want to get to so that you can get there, right? Whether it's lowering your debt levels or increasing top line, looking at, on a product basis, looking at your gross margins, all of those different aspects. A lot of people, when they plan or they're forward looking, they kind of throw numbers on a spreadsheet and look at them and try to track to them, but they don't have a game plan of how to get there. And so I think really that's kind of the management side or the management accounting side of it. And not only that, when you have your chart of accounts set and organized in a fashion where you can actually read them, I think it helps even close the books, right? So when you look at your balance sheet and you look at it by the buckets, you can on a daily basis as you're closing your books, you can, on the management side, you can see where, why is there a variance there, so forth and so on, we missed this entry. So then all of a sudden you don't have to go reopen, prior periods or, there's, big fluctuations. So, keep staying apples to apples. And then at the end of it, the forward-looking side of it, I think is so important to have those KPIs of saying, okay, this is the goal, this is where we are, how are we going to get there? And whether it's changing staffing models, increasing top line by, sometimes it's reducing a product line. If they're all of a sudden you look at the gross margins of certain product lines and it's propping up your revenue, but you're not making any money at it, and you're using a lot of your time and effort for that product, is it really worth it? And so then you have to look at that and the capital that's involved in said product. And so, really understanding the P&L, I think is on a more simplified basis. I mean, even, large insurance companies, they have a one-page P&L. So like, when you look at small businesses, it should be in line with that.
Yeah, I think that's in terms of like just trying to do trend analysis. I think the theme that I see too is just breaking it into smaller pieces like you're talking about, Patrick.
Yep.
And until you can do that, it's like fishing in the dark kind of thing. It's like you can't build any trend analysis because there's just too much in a bucket, so to speak. So it's really breaking those pieces into smaller buckets so you have visibility and then able to track some trend analysis. And once that's in place, it becomes, the light becomes brighter in terms of conviction with an owner or management.
Right. Yeah. So I think, from my prior experiences, I think that ability to look at the 10,000-foot level and then to be able also within one document really, zoom down into the weeds, I think is unbelievably helpful. And so, but you have to have that 10,000-foot view to understand where some problems are or if in some wins, right? There's wins and losses. And then to get down to that into the weeds and say, okay, this is a problem, or hey, we're making a ton of this margin is great on this product line. Let's focus on this. So I think ultimately that's, that's where everybody wants to get to. But part of it, like I said before, a lot of companies have so many band-aids on everything and their processes are somewhat antiquated. So, they can, when you look at it, you say, why do you do things this way? Well, that's how we've always done them. That's not, that could be an answer, but is it a great answer? Probably not. So, especially in regards to the new technologies and even Excel of having somebody on, to understand, oh, we can do this, we can push a button. All you gotta do is, code some VBA coding and so forth and so on, I think is super helpful in regards to the close.
Yeah, I could speak about our entities. We have 5 different companies, but even creating that management report, I'll use a couple like the CPA firm. We have different departments. The A&E department, the tax department, the outsourcing group, the advisory department, and breaking up our P&L into those different departments gives us a great management report that each department leader can manage to. And I know, Brian, you've got some other clients that you've gone in, and you as well, Patrick, just kind of broken up like from this one number to different lanes to identify opportunities to either improve margin or maybe you can improve margin. But the difference between a management accounting report versus just here's your P&L in total. And again, I think that's one of the things that as a group, we've been able to come in and provide that to our clients is, yes, this is your profit and loss. However, what are the key management reports that we want to look at and start to manage differently?
Yeah, and when you do break it down in those granular levels, it does a couple things. I think is just monitoring the performance, right? You can easily find when there's something wrong or when somebody's performing better, or identify things that we need to think about to how to improve, right? And brainstorm, well, how can we move this financial metric better? The gross margin, the pricing and cost of delivery. Those are really the 2 components, but until you can break it down into that level, and no more granular, and then roll it up, so you can look at both ways, up and then ground level. So
one thing I want to add to that is, you really need that, on a small business basis or any business in that matter, a gatekeeper of your, not just, when a lot of people think of chart of accounts, they think of, GL codes. Really, when you look at it, it's everything, right? That metrics or that cube basis of, location, department, so entity. You really have to have a gatekeeper in the accounting department to challenge when you add, said location or said department, because all of a sudden those things bloat, and then you're putting undue stress on your finance organization of splitting out something, and if it's not value added, it's wasted money, right? So wasted time. So I think in that reality, Brian, I think it's great to break things down, but when you get too granular and it doesn't add value, and if somebody isn't tracking a metric on that, let's say said location or said department, then it shouldn't be there, and it should be rolled up to a bigger group, essentially.
Yep. But that's why all those buckets that we just talked about, success factors they all work together, right? If you can't capture that on the transaction level so that it rolls up into the financials efficiently, you're never going to get that data timely.
Right.
And that's why it's important to be able to do that with software, and it's all combined.
Right. I've heard the term both historical financials and then forward-looking reporting. Patrick, can you talk about the difference and what that means?
Which one, the
Historical,
historical versus
historical.
forward looking? And so I kind of touched
Yeah.
on it a little bit, and I know we have a question out there, Corey, so after this, then maybe get to that one. The historical versus forward looking, I think is really important, right? It's kind of your roadmap, right? So you look at a plan, right? So for example, your 2024 plan or 2025 plan, but then you have a roadmap, excuse me. You have a roadmap looking forward of saying, you know, this is where we are and where do we want to be? And you know, you have to build those KPIs around that, whether it's EBITDA, you know, there's oodles of KPIs. But I think, you know, building out that roadmap and that plan from the historical pieces of where you're currently at, and I really think it's value added. You know, a lot of people do it at a high level: revenue, cost of goods sold, gross margin percent, OpEx, so forth and so on. I think it's really important that you know, and that this, and like Brian said, it's all encompassing, right? When you look at your chart of accounts, you plan down to the most granular level that you have. So, because it's very hard otherwise to say, well, you know, there was a win there, a loss there, but it netted out and we're good. Well, there might be a problem there. So I think really to plan by, like, for example, OpEx, plan on a vendor level of, you know, okay, you know, set amount of dollars is going to go to company ABC for advertising. That's what we're sticking to. And, you know, there's always these one-offs. And so that's why I think it's really important also, not just on that forward looking to do a, you know, a 5-year plan, a 3-year plan, and a 1-year plan, but also do reforecasting, you know, whether it's quarterly or monthly. It's not a rebuild of the whole plan, but it gives you a little bit better understanding on a pro forma basis of, you know, where you're going to end this year. And then kind of and that gives you a little bit more knowledge of, okay, we have to make these changes. Otherwise, next year is going to be systemically worse. And so, or better, or, you know, whether, you know, one way or the other. So.
Yeah, I
Yeah,
think,
go ahead, Brian.
yeah, I think just being able to articulate that, just to do any trend analysis, you have to have good historical information, and that takes time. That's what we have found. It'll, you know, from introduction to a brand new client, typically they don't have it organized in the right manner to launch some trends and so forth, and then be able to manage that. So it just takes time. And once you do get that, though, it becomes powerful and better conversations with the owners and management team, like you're talking about, of as far as digging into, hey, does this make sense, or do we need this, or can we change that, or do what you know, at that level, so that you can pick that out. So it just really, the end result of all that is just good conversations, and then the owner or management team have better conviction in their deciding what to do from a strategy and tactic standpoint, or in validating that they're doing the right thing. I think is what we see as the true value of those conversations.
And I know that one of the tools that we've been using is Giraffe, where it's connected to a lot of our clients use QuickBooks Online, but some of our operators that don't, we're able to connect to it as well. But again, it's a nice tool. And what you make me think about in regards of forward looking is or creating that budget. Even one of our presidents of one of our companies that does about 3 million in volume really spent a lot of time more on figuring out, here's our lanes, created the management report really for 2 core pieces of business, brought in the people that are involved in that on the revenue side to forecast that out, and then the personnel to support that. One was going to have significant growth, so forecasting out, adding personnel, and then as the years going along, whether we're on track or off track, and then retool it, maybe the revenue is coming in earlier or stronger than we anticipated. And then maybe we need to accelerate bringing that person on. But again, just looking at it, again, our organization looks at, okay, here's the month of February that we just closed, but how does the next month, are we on track based on production, shipping, product out? And then what does the remainder of the year look like? And that's where, Patrick, you're saying maybe sales are going stronger or maybe they're weaker. And again, one of the nice things with our clients that you guys are able to have that conversation is with the tax person, you know, with a better or poorer performance, what does that mean for sending in cash for taxes, which is a key component, you know, how much cash is needed.
Yeah.
Yep.
And just
So maybe
so everybody knows,
again,
giraffe is,
go ahead.
it is the animal, but it's is it JIRAV, giraffe? So you can Google that.
JIRAV,
It's
correct. Yep.
JIRAV.
And that's just one tool, right? There's
Yep,
a
yep.
plethora
That's
of
it.
tools out there of, you know, whether it's, you know, depending on how much, I mean, really it's the expense of it, right? Of, you know, a lot of them are pretty push button. Giraffe is very, very, very user friendly, very uh, uh, easy to navigate around in. Relatively easy to set up, but you know, you look at the little higher end tools like IBM and Oracle and, you know, data rails, Cube, so forth and so on, you know, a little bit harder to set up, but very, very powerful in regards to once you have that pre-accounting and and everything in place and you close your books in a timely fashion, it's like clockwork, right? And you can really look at your financial reports, whether it's bank reporting and or P&L or cash flow or so forth and so on, and create results.
Mhm. Yeah, and Patrick, maybe can you just kind of do a little deeper dive on the budgeting process? And again, I'd say historically, 5 years ago, we would do more. Oh, we expect our revenue to go up 5%. Our people costs are going to go up 7%. Our healthcare costs going to go up this percentage,
Yep.
and just kind of spreadsheet it out and go from there. But can you just talk a little more about the
Yeah.
process that?
I think, you know, a lot of people don't like the budgeting process because it's timely and it's not revenue generating, right? And so I think they kind of glaze over it and put a number down and say, okay, well, let's hit that. And so I really like to get down, and that's where you know, where I like understanding the 5 foot level or the 1 foot level, and then the 10,000 foot level. So really being able to say, okay, you know, account one, you know, I don't know, count 4,000. That's widget A. You know, you said we're gonna, you know, you're gonna grow by 15%, and how? And so in reality, you know, putting a basis behind why you think you're going to grow. Are you going to increase advertising? Well, that's on the OpEx line. And so going through the budgeting process and really digging into all of it, of saying, okay, we can't just throw a number on a spreadsheet and think it's going to happen. Either A, you have to have a game plan to you know, reduce OpEx or increase revenue. There's always a game plan for it. And you know, a lot of times when you're growing revenue, OpEx is going to grow also. Not all the time, but you know, sometimes. So, you know, understanding the relationship between those two, I think is huge. And then putting, you know, it's all about that roadmap of where you want to be in 1 year, 2 years, 3 years, 5 years. And so, and building out those KPIs and saying, okay, well, then it's that change management of, you know, I've seen have clients that, you know, they put a budget together and they do a great job, or we do a great job, and then they don't stick to it. And so it's really holding people to the fire of saying, okay, this is your budget. And so when you put, you know, for example, on the OpEx side, like we said on the credit cards, to have workflow in place, right? Every major corporation has workflow for any expenses. It all has to get approved up the line. And if it's over budget, then you got to go even higher up. So, you know, holding people's feet to the fire in regards to that, I think is key. But I think understanding the relationships and getting knowledge of, you know, for example, revenue of, you know, how are you going to grow? And and then building out a playbook too, I think is huge. And on the budget side, right? Because a lot of companies, especially, in the current environment, have a lot of turnover. So in regards to the budget, it always seems like it's a science project every single year to do the budget. And it's always different. So if you do it differently, it's not apples to apples. So really building out that playbook of saying, okay, this is step one, this is step two, this is step three, this is how we're going to do it and how we're going to do it moving forward too. So that the next person that steps into that seat can pick up the book and build the budget the same way.
Yeah, Brian, do you have any thoughts around that, or?
Yeah, again, going back to the principle, of breaking up into smaller pieces is key. And then, like Patrick said about revenue, it's not just put a number down, but what are the strategy and tactics underneath that number? Maybe it may be, you know what, we're gonna deliver the product not just through this method, through a distribution channel. We're gonna go to the end customer, talking about those discussions. But by putting just a vanilla number, there's got to be a story behind it. And that's what finance should be, collaborating with the operations as well as the owners and management team to pull that out. And it's more
And
of
again,
a collaboration process, and that should be ongoing measurement, right? It should be accountable. It's like, okay, what we agree to at the end of the year or whenever we put the line in the sand, it's going to change. We know that, but we can change the forecast. That's the difference between what we call budget versus forecast.
Yep.
We have a budget, kind of line in the sand, and then we know quarter in or 2 quarters in, it's going to change a little bit. And that's the forecast. And what's powerful about that is you can roll it to the end of the year, and then you get that tax planning involved because now you have some accuracy into the numbers, and then there's no surprises with, oh my gosh, we got to come up with $250,000 to pay taxes in January of the following year. It's like, no, we're tracking that all along. So it's all proactive kind of things.
Part of the, I think, the budgeting and planning processes too, like I said, you do it at the most granular level, but is understanding, when, for example, if you have different locations or different departments or stores or different revenue centers, is looking at the, and this comes back to the closing process of closing the books. A lot of companies, their allocation process to allocate, corporate overhead to said locations or departments is super vast, and you really can't wrap your head around it. And so, understanding that too, I think, and that comes back all the way to, question one, the assessment process of, understanding that. So like and that's the nice part about budgeting, having like a store contribution or a department contribution line versus, and then have a consolidated view. So you can kind of peel off that onion and understand, okay, this was just corporate overhead. Store is profitable, but they got an unfair percentage of the corporate overhead, or so forth and so on. But then the nice part about that is then you can say, okay, well, maybe our corporate overhead's too high. So, looking at all of the different pieces.
Yeah, as we're talking here, I think it really, that CFO function, or that, what do we call the third bucket, is really having business acumen to understand the business and then how the numbers apply, right?
Right.
And then how can we get more performance out of the business? How can we become a profit leader, a market leader in the business that we're in? That's what it's all about.
Corey, there is a question there if you want to on the Q&A.
I think we'll get it
At the
towards
end.
the end.
Okay. I
Yeah.
just want to make sure.
And again, what I'd say within our organization, what we've seen is, especially on the revenue side, that the different department heads that are responsible for their P&L, I'll call it that, is whether it's A&A group, hey, they're tracking their jobs that they've won, clients that might have sold that we've lost, and the development and investment that we're making within that department for employees in there. Our HR department, which includes a staff of 3. Now they have control over their budget and how they're managing it, and adjustments they have to make because while our IT group is growing at a significantly faster pace, so there's different activities that they need to do. In our marketing department, that they're going to be shifting dollars because we're going to try to grow a different department. And again, it's just like getting different people involved, and especially on the revenue side, having that conversation. You know, we hit our numbers, that's great. How does the next month, next quarter look like? Did revenue just get accelerated or not? Or is there more traction in the marketplace? Or we missed our number? What's our pipeline look like? You know, what is the market opportunity or what additional changes? So a lot of the instead of just saying the historical, which should validate your KPIs that Patrick, you keep referencing, your historical is a much shorter conversation. Like, okay, this validates everything that we've been measuring, but having that forward looking conversation is so important. And again, just like you said, Brian, it gives you an opportunity to talk about, you know, is my cash going to grow at the pace as that we're anticipating or not? And that might lead you to collections of receivables, better or worse, or deposits are up or down. Again, it just creates great conversation, not just between the fractional CFO and the owner or president or CEO, but you could bring different stakeholders into that conversation. How do you impact the performance going forward?
I always like the saying, you know, the rear view mirror is much smaller than the windshield, right? So looking at it in that aspect, you know, that stuff has happened. As long as it's locked and set and done, that's a great understanding of the story that's been told, but really look forward through the windshield and understand where the story is going to go.
Yeah, and
Yeah.
I would submit a good skilled CFO also gets those department heads involved, right? And collaborates with them as part of a team, like a team effort with regard to that. We're not working against each other, we're working with each other. And ultimately, hopefully the company will perform better. So getting them more involved in that is great and much needed.
Yeah. And the one thing I would like is the feedback that we've gotten from a lot of the clients that we've been started working with in the last 12, 20, 24 months is that they have wished they had done this before because the investment in the team that you're really getting, a fractional CFO, controller, and senior account, the cost associated with having that team and creating the conversations, implementing the tools is worth it. Because again, you're so concentrated on the future, not the historical component. There is the one question. I don't know if anybody else has any other questions. Just throw them in the chat. One is, how do you transition to a fractional CFO for succession planning if the business partner who is in charge of the accounting begins to exit responsibilities? So Patrick or Brian, if you have.
Yeah, so that's a perfect example of how we start with clients is we do an assessment because you have to get the current state. Your current leader knows the information, but probably nobody else in the organization. Furthermore, again, going back to how do you measure where you are at, you have to have some benchmark, and that's what we would do. We would go in, we would do an assessment, we'd give you a report with regard to, hey, this is your current situation. This is where you need to be, and this is the recommendations on how to get there. And then that would be a complete project, an assessment project for you. And whether you go with, you know, a CPA firm or somebody, make sure you do that assessment instead of just throwing I would highly recommend instead of just filling that role with a person is to get some insight with regard to that.
And I would say, I would second that, Brian, that I think the assessment is ultra critical in regards to peeling off those Band-Aids that have been put on for, who knows, 5, 10, 15, 20, 30 years of, different processes, different systems, whether it's a new GL or, that's in the worst case scenario, but, really looking at every process and saying, okay, well, we have 10 different FTEs here, but if we change these 3, all of a sudden we have 7 or 6, or, and really looking at I think the assessment is so valuable just for the fact that you look at every aspect of the company from, like I say, 1 inch to 10,000 feet of everything in regards to processes, staffing model, revenue lines, so forth and so on.
Yeah, and I guess I can speak to this a little bit only because about 3 years ago, we had one of our senior partners that oversaw all the accounting for 30 plus years of all of our entities, organizations. And when he left, 2 things. One is he was able to transfer some of, I call it tribal knowledge of how he did things to our new CFO. However, then the other half of the tribal knowledge walked out with him. And then unfortunately, we ended up switching CFOs like 8 months later. Again, that balance, that tribal knowledge left. And so much of the accounting was driven and handled by that individual versus being a process, and having others involved in it, that it was a challenge. And again, that's where the assessment, even for all of our organizations to go through and understand all these cycles and how we can plug in this technology to make things more efficient and more of a defined process within our organization was huge. So now it's really not dependent on that one core person. It's really dependent on all the participants, all the people within the operations, because they're fully aware of, their budget area that they're responsible, the reports they're getting, as well as on the using a tool like Expensify or Bill.com and having operations involved in the whole defined process was significant for us as an organization.
And I will say too, Corey, on the when to go back a couple questions on the Expensify and Bill.com, you look at that and you look at all the time and effort and printing costs that a lot of companies have in regards to invoices. So when you get to audit time, you have to go dig through filing cabinets, whereas Bill.com, Expensify, everything is housed in the cloud. So, that ease, not just on the closing the book side, but on the audit side, on any type of research, it's so much easier to dig into that stuff. I don't think you could stress enough, implementing the new tools that are out there for businesses.
Right, and really getting operations who are really they initiate the transaction, they understand the transaction, and having that invoice go to them in a defined process, and then they validate the coding or do the coding of that expenditure and approve it in a system. And then there's can be additional approval process around that,
right,
in a defined process. It is so important. We do have another question. Does or can a fractional CFO take place of a third-party independent controller?
Yeah, so going
right,
back to kind of the framework, to be a successful CFO, fractional CFO, they need the other 2 buckets that we've talked about, right? But that doesn't mean that we have to perform both of those buckets. So some of our clients, they may have a strong controller, but they don't have that CFO, forward-looking business acumen, all those things that we've been talking about. So certainly it's possible, but again, we would start with the assessment, because the only way that from a fractional CFO, whoever that may be, to be successful, they have to optimize bucket number 1 and bucket number 2 that we've talked about. If that's not optimized, they're gonna struggle. And so we would go in there and do an assessment and figure out a plan for that business and succeeding the previous person's role. Hopefully that.
Yeah, no, one thing I'll add to that, Brian, is it's interesting, and I'm thinking of one of our clients, about 30 million and growing, and has done some acquisitions. They have a great controller in closing their books. So going through the assessment and helping implement these tools, whether it's a controller or bookkeeper, office manager, we've received great support from those individuals, because again, it just makes their job and life easier, as well as operations seems to really embrace it. Because again, I'll use the credit card. Who wants to get a spreadsheet where I got to code credit card transactions 15, 30 days after I did it, versus I could just do it on the front end. And I don't have to have a circular relationship with the accounting department. So again, just going through the assessment, seeing if we can leverage technology tools, even the budgeting process, whether it's if you have a bookkeeper, office manager, or controller, we can support that.
Yep.
And, part of that assessment too, and I love, this piece of it, I think is really valuable too, is that a lot of companies are perpetually closing. They're closing all the time, and they finish a month and they start right into the next month, so they can't process improve. So I think these tools really help, and not only that, in regards to, your finance folks or your employees to perpetually close. It's always like they're in the fire. So not only that, these tools also help employee morale and that family work-life balance that I think everybody wants. So
Yeah, we've got another question here. I get the importance of a good accounting, historical analysis, forecasting, analyzing trends in the financial statements, but how do you get the business owners, stakeholders in the right info, KPI data they need during a month to know if they are operationally on track to hit the forecast? So another way, financial KPIs always seem to tell a story in the reactive versus proactive way. I agree. A lot of times we start by asking the operators, what is the key information you're looking at on a daily, weekly basis? And that actually helps give a foundation of KPIs. And again, because the forward-looking, you should be talking about those KPIs that you're looking at, whether it's a daily, weekly. For example, the CPA firm, we're looking at production hours, delivery of product. Are we on track or off track? I'm trying to think of like our managed service group or our IT group are they onboarding managed service agreements? Are they growing? They're hitting their numbers, and then what is the satisfaction of existing customer clients as well? Those are two examples that I know that our operators look at, and then we're looking at that on a weekly basis with them from a leadership standpoint.
And I think part of it too is the, when you talk about, updated KPIs throughout the month. So let's say for April, right, it starts at the beginning process, right, at that pre-accounting level, and making sure everything gets booked, not real time, but close to real time. So you can actually make decisions early on and part of that too is for example, on the OpEx side to have that workflow in place. So when a check is cut or an expense is accepted, that there's some guidance from somebody's leadership or so forth and so on. I think you really have to really it's that pre-accounting to get everything in the books. And then, so then you can run updated financials. So like, for example, Giraffe or any of these reporting systems, they can be real time. You can load them every day if you'd like, or, a lot of them load by themselves. And so to go in there and look at the KPIs, look at the dashboards, it's all real time, but it all depends on how you're booking all of the accounting. So.
Again, well, I see we're at the top of the hour. Patrick and Brian, again, thank you for your time and conversation on this subject. And hopefully individuals were able to take away, I call it a golden nugget or two from this conversation that you can bring back to your group and implement or use in running your business or accounting department. Again, thanks for everyone that took the time out of their day to join us. And hopefully, again, you got a golden nugget. Patrick, Brian, you guys have a great rest of the day. And thank you again.
Thank you.
Thank you. Thanks, Corey. Thank you, everybody.
Yep, bye.